right? And also allow me to share my screen here. Okay, so we are continuing with our revision. Let us just get any of the material from our revision packages so that we get things started. Right? Concerning the mocks, I'm sure quite a number of these you students have covered this. Let me see what is in September, December 2019. Okay. All right. Let us do September, December 2019 question paper and see how it goes. September, December 2019. Right. Oh, sorry, team. It appears flu wants to take a toll on me, and unfortunately, it's during the summer season, the hot season. You know that flu is not user friendly. You know, in cold season you can give it a benefit of doubt, but in the hot seasons, something else. So I want to send the question paper in our WhatsApp class group, September, December 2019. September, December 2019. Okay, so that's the question paper. Make sure you have received it and you now have it. Now, let us read along the question paper. I've already opened it. Okay, so this one is for SBR. Let me close this. Let me focus on this. The company in question is Okan Company. Okan is a large listed company located in Yarseland whose currency is the Yarseland dollar, and it manufactures engines and engine parts. It is considering whether or not to invest in one of two new 4A projects, Project Alpha or Project Beta. Details of both projects are given separately. Previously, Okan has used the relevant risk-free discount rates to calculate the net present value of the projects. However, the finance director believes that calculating adjusted present values of projects would be more appropriate. Okan Company wants to base its decision on which project to invest in on the returns generated by the project's risk as measured by their project durations, and important non-financial aspects. Both projects are due to commence in 6 months' time. Right, funding for projects Alpha and Beta. Project Alpha or Beta will require the same initial investment, which is 50 million Yarseland dollars. The proceeds from the sale of the factory in Europe in 6 months' time, which is 10,000, will provide part of the funding, and balance will be financed by debt borrowing. Okan Company expects to hedge 10 million euros using either forward or money markets The following information is available on these markets. Now, someone had said, say, may you send the handout on hedging? Let me see if I have it, but I'm sure I have it. The handout on hedging, AFM hedging interest rate and currency risks. So they are. This is the handout you are asking for. Okay, so continuing. So are you noticing that they are saying the projects, they need 50 million, but how they are going to fund it is they want to sell a factory in Europe for which is worth 10 million. So in other words, we're expecting to receive 10 million euros, but our currency is ESL and dollars. So they want to hedge this 10 million euro receipt using either forward markets or money markets. The following information is available on these markets. Spot, which is today's rate, and the 6-month forward. Bank interest rates for Y and Euro. Balance of funding raised by domestic debt will be through a 4-year subsidized loan on which interest is payable at 2.1%, although Okan's normal borrowing rate is 5%. The issue costs related to raising of this finance will be 3% of gross sales proceeds. Okay. Project Alpha's base case NPV and APV in 6 months' time when project will commence should be estimated using the following information. Sales revenues and production costs in 6 months' time before any price or cost increases are estimated as follows. So these are sales revenue and production costs. It is expected that sales price will increase at an annual inflation rate of 10%. Domestic production costs are likely to increase at a silent inflation rate. So we want to see what is the silent annual inflation rate. We have to figure it out where it is. In addition to the above, components will be imported from UK. So they are importing some of the components from UK at the following current costs. So these are in pounds. So these are costs. Costs of components from UK are fixed and are not subject to inflation. So these ones are not subject to inflation. The funds of 50 million for Project Alpha will be used to purchase plant and equipment for manufacturing purposes. Tax allowable depreciation is available on the value of plant and equipment at 25% per year on a reducing balance basis, with a balancing allowance or charge applicable at the end of the project. The plant and equipment is expected to be sold for 10 million post-inflation at the end. At the start of every year, Project Alpha will require working capital. In the first year, this will be 10% of the estimated year 1 sales revenue. In subsequent years, the project will require an increase or reduction in working capital of 15% for every dollar increase or decrease in sales. The working capital is expected to be fully recovered when Project Alpha ceases. The expected spot exchange rate between dollar and euro in 6 months' time is expected to be 3.03 per pound. The annual inflation rates are 2% in UK and 4% in Ireland. It can be assumed that these inflation rates will not change for the foreseeable future. The cost of capital for upraising the base case, the net present value of Project Alpha is 10%. Okan company pays tax at an annual rate of 20%. Tax is payable in the same year as the profit is based on. Okan makes sufficient profits from other activities to take advantage of any tax loss relief. Project beta details. Given below are project beta's base case present values based on the project start date in 6 months' time, discounted at the project's relevant risk adjusted or equity financed discount rates. Yeah, so you're given, these are already present values, so sorted. it can be assumed that any working capital requirements for beta are included in the annual cash flows. Project beta's duration has been calculated at 2.43 years based on its best case present values, economic risk, and risk categories. One of Okan's subsidiaries in Yaseland, which produces and sells its products domestically, has still found that it is exposed to economic risk exposure. The directors of the subsidiary believes that this is because the Yaseland government has maintained comparatively higher interest rates, even though inflation in Yaseland is now under control. Okan categorizes the risks in its projects according to severity of their impact and the frequency of their occurrence as follows, meaning severe and frequent, not severe but frequent, severe but not frequent, and neither severe nor frequent. Okay, discuss why a company may prefer to use adjusted present value rather than net present value formats. Right, so talk to yourself. Remember, if you have played last week's video, which was on APV, it was why APV. Now, Lontia, I welcome you to this revision session. I want you to tell me whatever can come to your mind. Why is it we calculate adjusted present value rather than just going by conventional NPV analysis? What is the wisdom behind that? Gracious, you can unmute and talk to yourself. Lontia, go ahead. Yes. Yes, Lontia. I'm sure we are having issues with your audio. Gracious, do you want to try? Why is it we calculate APV instead of just going by decision making based on traditional NPV analysis? Talk to me. Mrs. Zingle, if you can hear me, this question is the same. Why is it we calculate APV rather than going by traditional NPV analysis? So for that.
Can you hear me now?
Yes, I can hear you.
Okay, I think because
the financing side. And
okay, go ahead, Gracious. Okay, come again, Ms. Ngube.
I think probably because APV separates different types of cash flows. So managers are able to see which part of the project cash flows generates, what cash flows and maybe value.
Yes.
Like that.
Yes. Oh, you know, I like this, especially at television phase, that you just let me know how you understand it. What you are saying is the APV approach helps managers to better understand how the project is generating value for shareholders, because it separates investment cash flows or project cash flows from financing cash flows. In so doing, the APV approach helps managers to determine the value created by the project from investment of shareholders' funds. That is called base case NPV. And then additional value created by the project from the manner in which the project is financed. That is called what? A PV of debt financing side effects. Let me repeat that statement. APV approach, unlike NPV approach, APV approach separates cash flows from a project into those which are investment cash flows, meaning cash flows generated by the investment of shareholders' funds, and cash flows which arise from the manner in which the project is financed, that is debt financing cash flows. In so doing, if you are a manager who is using NPV approach, you are able to determine the value created by the project, meaning the value created from investment of shareholders' funds. We call that base case NPV. And the additional value created from the manner in which the project is financed, which is the PV of debt financing side effects. So there you go. That's your formats there. Prepare a report for the board of directors, which in our first video, I told you that a report, you prepare it on the word processor, and then you perform all workings in the appendices to the report, which is the spreadsheet response option. The minimum debt finance required. Okay, so let me add my spreadsheet response option here. We want to see the minimum debt finance required. So what we know from the question so far is the project needs 50 million. Project needs 50 million. So what you do in appendix, you say appendix, this is an appendix to your report, appendix 1, which is hedging outcomes. Hedging outcomes. Let us see what the hedging outcomes will be using either forward or money market. So we are expecting 10 million euro receipt. So you simply say 10 million euro receipt, or you can put euro like this, the 10 million euro receipt expected in 6 months time, can be hedged using one when then you say one forward the hedge, forward exchange contract. Now if you are to use forward exchange contract, you simply say of the two exchange rate here, 6 months exchange rate, you want to convert these euros. You want to convert euros to your silent dollars. So which of the two rates do you use? Do you use 2,5462 or 2,6121? Talk to yourself. Which of the two rates there do you use?
I think 2,5462.
Yes, you use 2,5462 because when you are receiving, notice, when you are receiving, you use the rate in which you get less in domestic currency. Your domestic currency is your silent dollars. So the rate which gives you less is 2,54. If it was a payment of 10 million, you use the rate in which you pay more in domestic currencies. So in this case, you simply say the YS, your silent dollar receipt from 6 months forward, exchange contract is, so we are saying 10 million multiplied by 2,5462, and you get the answer is 25,462,000. 25,462,000. Yeah. So this is the forward outcome. Then 2, money market hedge. Money market hedge. That's your 2. Money market hedge. Money market hedge. Now, when you are using money market hedge, you remember this is a receipt. When you are using money market hedge for forex receipt, remember what I said. You have the videos already, team. It's a matter of saying for forex receipt, this is how you use money market to hedge it. You borrow. What you do is you borrow forex like this. Borrow forex dash dash dash. Convert to domestic. Convert to domestic at spot rate. At spot rate dash 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 dash. Place in the deposit account. Deposit account over the credit term. The credit term. So it's like this. We're expecting to receive 10 million. So we are borrowing forex. I told you it's a matter of saying how much are we expecting to receive 10 million euros. So you're borrowing the amount you borrow. You need the euro borrowing rate first from the question. So the euro borrowing rate here, it's what? It's 2,2. That's the euro borrowing rate, the forex you want to receive. Now what you do is, this is per annum. So what you do is it becomes 1,1. So the amount you borrow, it becomes 10 million divided by, open bracket, 1 plus 2,2, it becomes 0,011. What I have done here, I have divided 10 million. I have divided 2,2% by 6 months to make it 6 months. Now it says borrow forex. What do? Convert this forex to spot. Now at spot, you multiply it by spot here. That's to convert by spot exchange rate. What is your spot? You come to the question. Your spot is 2,5210. 2,5210. Now, in proper terms, you can first find the answer here and then multiply. But you can just punch it throughout in the calculator once and just find equals. And then what do you do after converting at spot? You are now placing in a deposit. It's now domestic. So you're now placing in a deposit. By placing in a deposit, you're multiplying by your silent investing, which is 2,4. And then if you divide by 2 for 6 months, it becomes 1,2. So you're now depositing it at 1 plus 0,012 equals. So right away you have the answer. Let us punch it in the calculator. I don't have a calculator with me, but I can still use my Excel here to teach you, because this is what we're supposed to be doing. So you're saying equals 10 million 123 divided by 1,011 multiplied by 2,5210 multiplied by 1,012 equals. So this is the receipt from money market. So forward gives us this, money market gives us this. So you can now comment and say money market, forward receipt, forward hedge is recommended. Forward hedge is recommended. So we can recommend forward hedge here. Why? Because it gives us more. So if we now say forward hedge is recommended, we can now say minimum debt finance required. Minimum debt finance required. So the minimum debt finance required equals, remember the money you have, you require is 50 million silent dollars. Then you say 50 million minus forward gave you what? Forward gave you 25,462 million. 25,462 million. 462 million. So meaning the minimum debt that is required equals 50 minus this year. So this is the minimum debt finance required. So that's the answer to your first question. And I told you how you present this. This is in the workings, in the appendices. So what you simply do is you simply say computations in appendix 1. Computations in appendix 1 points to the fact that the forward hedge is financially beneficial, giving a minimum debt required for the project of 24,538, full stop. So for these first, how many marks? For these first 4 marks, the statement you only write in the main body of the report is that computations in appendix 1 points to the fact that the forward exchange contract is financially viable, giving rise to a minimum debt requirement of 20, that figure there. Okay. Now next. Estimate project alpha and project beta's best case NPV in 6 months' time before considering debt financing side effects. So this one is easy. It's a matter of coming here and say project is alpha's best case NPV. Alpha's best case NPV. You know, NPV, best case NPV, it's NPV that we calculate on the assumption that the project is all equity financed. The project is all equity financed. So we are given here that the cost of capital for upraising best case NPV for project alpha is 10%. It is given. Now, if this is not given, you calculate it, and I have multiple videos where I showed you how this is calculated in the event that it is not given. So let us compute. But still on this, you know that inflation in your silent is 4%. Inflation in your silent is 4%. So revenues are before inflation of 10%. So it's a matter of coming in and say yeah. That's a matter of saying 0, 1, 2, 3, 4. So these are 4 years. And remember, if you are calculating, these figures are in your silent dollars. Your silent dollar millions. The figures are in your silent dollar millions. So let's copy, then paste. All right. Then revenue. Notice how pacey you should be when you're making these computations. So revenue is how much? 15,750. 15,750. So are these millions or dollars? Let me check. They are thousands. So let me put thousands here instead of millions. Copy this. Okay, sorry. I wanted to say to shift. Okay, sorry for that. 28,350 here. And then here it's 47,250. 47,250. Here it's 23,100. 23,100. So this is your revenue figures. And then you say production costs. Production costs, they are saying they are before taking into account your silent inflation. And your silent inflation, oh, sorry, Tim, I'm yet to inflate this. So when you're inflating, remember it's a matter of saying equals. The figure you're given is say times, if it's 10%, 1,1 to the power 1 for the first year. For the second year, it's a matter of saying equals this times 1,1 to the power is shift 6,2 like that. For the third year, you say equals this times 1,1 to the power 3. And then lastly, you come here and say equals the figures which are given equals this multiplied by 1,1 power 4. Right. So there you are. And then production costs. These domestic production costs, they are saying they are before inflation of 4%, which is their silent inflation. They simply say the annual inflation rate, and we have it right at the bottom here that it is 4% here. So it's a matter of taking this figure 6,120 times, so you come here and say equals minus 6,120 multiplied by 1,04. That's 4% to the power 1. So you can drag and then edit your figures like this. Now I'm editing my figures. In year 2 it's 10, 7, 10. So I just come here on my formula, instead of 6,120 I say 10, 7, 10, 10, 7, 10. All right, enter. In year 3, instead of 6,120 I put 21,420. So I come here and say 21,420. 21,420 like that, enter. In year 4 I come here and say 8,160 and put 8,160 here. 8,160. Now I have inflated my figures here. Then there are component transfers. Some are being transferred from UK. So these, let me say working one. Working one. I'll come to working one, but I have to proceed. I always tell you that. Then what else? So this is component transfers, working one. Remember why we can't put these figures here. They are in pounds and our figures here are in your silent dollars. So we have to convert them to pounds using forecast exchange rates. And if these exchange rates are not given, we can determine these exchange rates using either purchasing power parity or interest rate parity, depending on what we are given. Now we are given inflation rates, so clearly we need purchasing power parity. And then you say, if we're at this level, you can say tax allowable depreciation. And then after getting tax allowable depreciation, you can bold this line what you get is taxable income. Notice, I am proceeding before I do my workings because my spreadsheet on the exam software doesn't allow me to insert. So if I leave out a few lines or few rows, I may run the risk of the need to insert. So what is my taxable income? All I have to do is to bold this part to get taxable income. It is the sum of everything here. That one in negative, it will be subtracted right away. So that's my taxable income. I just drag it right like this. Then I say tax at. I check the tax rate here. What is the tax rate? Check what is the tax rate that I'm given. Tax is at an annual rate of 20%. So I know I have 20% here. So I put 20%. Then I check whether it is paid in the year in which the tax liability arises. Yes, it's paid in the same year. So all I have to do is to say equals minus 0.2 multiplied by this figure here. Why minus? Because tax is it's a payment we are paying out like this. And then I say add back third. I have put it there because I just needed what? Capital allowances. So equals, remember it was a negative, so I'm adding it back. After adding it back like this, I say incremental working capital. Incremental working capital. Now, concerning working capital, it's a matter of coming to the question here, which says, at the start of every year, Project Alpha will require working capital. In the first year, this will be 10% of the estimated year one sales revenue. In subsequent years, it will be 15% of every dollar increase or decrease, respectively. So first year 10%, first year working capital is a matter of saying equals minus 0.1 multiplied by year one sales. So this is the first year. Then in subsequent years, they are saying it's 15%, so equals minus 0.15 of every dollar increase or decrease. So multiply by bracket. You say sales for year one minus sales for year two, for you to know whether there was an increase or decrease. So you can see here. Oh, sorry. I was supposed to do it this way. Equals 15% of the difference here. So if I drag it, I get to year 4 because to year 3 because working capital starts from year 0. So you can see year 3 is working capital is positive because the sales decreased from 62,000 to 33,000. So if you say 15% of the decrease, it will be working capital, it will be an inflow because it decreased. If it increased, it will be negative like this. Now, what about year 0? Year 4, sorry. So they are saying working capital is expected to be fully released when Project Alpha ceases. So that means year 0 cash flow on working capital, it's a matter of saying equals sum. Every investment that you have here in working capital is expected to be fully recovered. So this amount here, you will recover it when, so there were negatives, and then no. So for it to be because a recovery of cash of working capital is a positive cash flow, so it's 4026 like this. So are you noticing that if you add this working capital figure, another way was simply saying this was my investment in working capital and the sum is 4206. So when they say they want it to be recovered, it is that amount you recover in year 4, because that's the amount you have invested in working capital. Then initial cost. Initial cost. We are told that the project needs 50,000, so it's minus 50. 1, 2, 3. Then residual value. Residual value. Residual value. Are you not seeing something? I haven't made the calculation for TAD and stuff because I want my table to be complete first. Residual value is the amount the plant is to be sold for, which is 10 million. It's given here. 10, 1, 2, 3. With this, I now have my net cash flows. Net cash flow. Net cash flow. And net cash flow I'm adding from taxable income to the end here. That's my net cash flows. I drag it. There you are. Now, net cash flow line, you again need to bold it. Just put it in bold like this. Nothing much. The comma and whatever. So you then say, if you now have net cash flows, you then say discounting factor at 10%. Why are we putting discounting factor rather than just using shortcut? It's because they want us to calculate what is called project duration. But let me stick to the shortcuts I always tell you. Let me stick to the shortcuts I always tell you. You then say base case NPV. Base NPV at 10%. Or you come here and say equals NPV. Open bracket. You put the rate, which is 10%. Put a comma. Now highlight all figures from here. Years 1 to the end. Close bracket and then add year 0 cash flow because it's a negative. So that's your base case NPV. But remember, it's yet to be fully calculated because we are yet to have some workings. Why is it we didn't jump to workings? Because in an exam, you don't know how many rows you need. So just say working 1, move on, working, move, like TAD. This is working 2. So you can now safely say workings and you know on the go. Workings. Workings. So the first working is components, component transfers. Component transfers. We want to see how much in your silent dollars did we transfer. So you say price in pounds. Price in pounds. Where's my pound sign on my thing here? Oh, price in pounds. Why can't I just say in price in pounds? Let me type pounds. Now, price in pounds. So remember, this is year 1, 2, 3, 4. The price in pounds are given. The prices in pounds are given. 1,200, 1,800, 3,700. 1,200, 1,800, 3,700. And then last year, 1,400. So these are the prices in pounds. And then you then say exchange rate. Exchange rate. Then this is now your sale and dollars per euro, like this. Your sale and dollars per pound. Sale and dollars per pound. This you are going to get this using PPP. Or parity. Why are you going to use PPP? It's because we are given the exchange rate, we are given inflation rates. So when you are given inflation rates, you are going to use PPP. Now, the spot exchange rate here is 3.03 per pound. It means pound is the base, is the denominator. Pound is the denominator. So they are saying the spot exchange rate between in 6 months' time is this. So we now want to find the forecasted exchange rates now using purchasing power parity. So formula for purchasing power parity, we will be simply saying 3.03 times open bracket assailant inflation, because it's the price currency, that's the numerator, which is 1.04 divided by UK inflation, which is the base because it's given as unit, 1.02. You say to the power n, where n is your year. To the power n, if it's year 1 to the power 1, if it's year 2 to the power 2. I'm teaching you shortcuts for you to complete the exam. So it goes 3.03 multiplied by open bracket 1.04 divided by 1.02 close bracket to the power year, like this. It's a matter of getting it like this, and right away you have your exchange rate. Then if you multiply these now, you now have price, you now have cost in your silent dollars. Cost in your silent dollars. So it's a matter of saying equals this here, multiply by this to get the cost in your silent dollars. You drag this, you come to your working, you now say transfers, because these are costs, you say equals minus. You come to this here, and you get the figures, enter, you drag, all right. Then tax allowable depreciation, that's another working. Tax allowable depreciation, third. Tax allowable depreciation. This is easy. You simply say tax base at start. Tax base at start. Then capital third at what? Come to the question. What is the capital allowance? They're saying plant and equipment, it will be 25% per annum using reducing balance. 25% per annum using reducing balance. So it's 25%. And then tax base at end. Tax base at end. Now, with this, remember tax, the years are the same. That's tax base, it's 50,000. We know that in the final year it has to be 10,000, meaning the residual value there. That will be the tax base at end for the 4th year. Now, capital allowances is simply equals 0.25 here, multiplied by this. We have tax base at end, which is this minus this. Now, if it's a reducing balance, closing balance for the previous year is the opening for the next year. So we can drag like this, we equally drag this, and we drag this. Now, notice in the final year, I have not yet calculated, because this final year, we find it by balancing figure. No wonder why they say with a balancing allowance or charge at the end, meaning you just put residual value here and the balance to from this line to the figure you have to subtract to get this is the capital allowances. If they said 0, you put 0 where 10,000 is, so the capital allowance become 21. So here it's a balancing figure, which is this, equals this here minus this. It's a balancing figure. So after doing this, you then say tax benefit. Oh, sorry. There's no need for tax benefit because we just needed to calculate this. So you come to the working where we said third working true. So you say equals, and then I copy the third line here because it's an allowance, so it's a minus. Right? You drag it like this. Notice, once I'm done with my workings, I'm already done with my NPV because it was being computed right away. It was being computed right away. So all I have to do, perhaps, in the interest of neatness, is to observe my monetary notation, or for your interest, to put numbers, negatives in red. But you can't do this in an exam anyway. So this is your NPV. This is your base case NPV. Now, Mrs. Who is here? Mrs. Zingli, are you not seeing how super fast your says?
Yes.
That is the area you have to work. You know, I could have sent, as I told you, I have recorded videos for this. I could have sent this in a recorded video, but I know I have to be showing you how these things are done super fast. Now, base case NPV, that one was for project alpha. Now we want base case NPV for project beta. 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 Now, when it comes to project beta, everything is calculated. Everything is calculated. So it's a matter of saying, it's 0, 1, 2, 3, 4. And then we say Pvs of cash flows. Pvs of cash flows. Now, what were the Pvs of cash flows? In the first year, we are not even told of working capital and stuff. So all you have to do is to put 50,000 minus 50,000 here. And then thereafter, PVs are already calculated. So they are saying 8450, 19,360. 8450, 19,360. 8450, 19,360. 22,340. 22,340. And then 4,950. 4,950. Okay, so there you go. So it's a matter of now saying base case NPV equals sum of PVs. Base case NPV sum of PVs. Sum of these equals 2. So it's a matter of saying equals sum, right? Those brackets there, and 5,100. So that one is easy stuff. And then, so this is what the question wanted, and how many marks were allocated to this part of the question? 12. So notice in an exam, Ms. Zingli, I already have 20 out of 50. I already have 20 out of 50. So to pass this question, remember it's a compulsory question, I only need 5. It's no wonder why I always tell you it's doable, because you need to quickly wrap up this question and move to section B, because it's equally compulsory, meaning if you fail section B and it's not compensated by more marks you get in section A. They're saying calculate project's alpha and beta's APV in 6 months time. Now all you have to do is you then say PV of debt financing side effects. That's working number 3, which is PV of debt financing side effects. Financing side effects. Debt financing side effects. Now, PV of debt financing side effects. So what you do is you simply say, yeah. Now they are saying is when you check whether the loan is amortized or not first. Here they say the balance of funding raised is by a 4-year subsidized loan with interest payable. Okay, so this loan, of course, it's subsidized. We are not told whether it's being amortized. So the normal rate of borrowing is 5%, but we are going to get what? We are going to get and then we need to check if issue costs are subject to tax. Let me see. They're saying tax payable in the same year as Okan makes sufficient profits in other activities to take advantage of. So let us assume that issue costs are subject to tax. So you can assume that issue costs are not, because the examiner is silent, it's still fine. But I would assume they are subject to costs. So it's year 0, then year 1 to 4, year 0 and year 1 to 4 there. Year 0 and year 1 to 4. Now, issue costs. Issue costs here is a matter of saying the loan you needed. Remember, we calculated the loan required here. We calculated the loan required somewhere. Oh, no. Where is my thing? Oh, well, here it is. What happened? What happened? We calculated the loan required somewhere at the top. 24,538. This is the loan that is required. 24,538. So it would make a lot of sense if we state that fact to say loan required. Loan required is 24,538. Now issue costs. Now when they say issue costs are 3% of the gross sales proceeds. Issue costs are 3% of gross sales proceeds. It means this loan of 24,000, it is after taking out issue costs. So it's actually 97%. It's what is left after taking out issue costs. So issue costs, you say equals minus 3 over 97 multiplied by this. So that's issue costs. So let me delete this and say year 1 and then say year 1 to 4 here. Year 1 and year 1 and here year 1 to 4. So you then say tax benefit on issue costs, tax benefit on issue costs. It will be in year 1. No tax is paid in 0, remember, because 0.20% multiplied by the issue costs. Because it's a tax benefit, no wonder why it's positive. And then you say tax benefit on interest. You say subsidy benefit, actually. Subsidy benefit. Notice the loan you are getting is 24,538. 1, 2, 3. Of this loan, you are paying interest of 2.1, yet normal borrowing interest is 5%. So you are benefiting the difference. You say multiply by, you say 5% minus 2.1%, because that's your benefit. Because this is a benefit, you pay tax on it. You pay tax on this benefit because it's income to you. So you then multiply by 80%, meaning you get what is left after you pay tax on that benefit. So if tax is 20%, it means the actual benefit to you is what is left. And this is equals loan here, multiplied by open bracket 5% minus 2.1%, close bracket, multiplied by 0.8. Right? So this is the benefit that you'll be getting per annum. And then there is tax benefit on loan interest. Tax benefit on loan interest. Tax benefit on loan interest is again saying the loan, which is 24,538, 1, 2, 3, multiplied by 2.1%, because that's the interest you are paying. Then multiply by 20%, which is your tax rate. Close bracket. Again, this is from year 1 to year 4 equals loan multiplied by 2.1% multiplied by 0.2, and so there you are. So these are the cash flow consequences of debt financing. Cash flow consequences of debt financing, which is net cash flows. Net cash flows equals, okay, again, I can simply escape and just add these through to this, say sum, right, and then drag, then discounting factor at 5%, because this is debt financing. What the interest rate you use to discount is the cost of debt, which is normal borrowing rate, which is 5%. So you then say discounting factor at 5%. You don't use cost of equity to discount cash flows on debt. So in year 0 it's 1, of course. Then in year 1 equals 1 over 1,05. Then in year 1 to 4, this is an annuity. Annuity at 5% for 4 years. You can get this annuity. Right away from your question in the tables. Annuity, page down. 5% 4 years, it's 4.329. 4.329. Then I come here and I put 4.329. 4.329. Then I get my PVs. What are my PVs? Right there. PVs equals this multiplied by this, right? Then I drag it. You can do the degree of accuracy later, the issue of making sure that the numbers are properly written. You can do this later. Say NPV equals E of these equals sum, bracket here, drag this bracket, enter. So this is the PV of debt financing side effects, 2,261,000 etc. Then I say summary. I then say summary, or I can say project alpha here, alpha, and here I say project beta, project alpha, project beta. So I say here project alpha, project beta. Then you say best case NPV, best case NPV equals, come here. For project alpha, I have calculated it and it came out as 5263. For project beta, I've calculated it and it came out to be 5100. Then you say PV of debt financing side effects, PV of debt financing PV of debt financing is the same for both projects. So here you are. Okay, there you go. Now the degree of accuracy is different. So you would rather divide this by 1000 so that our figures will continue to make sense. Remember that. Otherwise, you say you get a shocking number there. And then after doing this, you then say adjusted present value. Adjusted present value, which is your APV. APV. That's what it stands for. So it's the sum of this 7559 and then 73. Then if you see these figures not being the same, it might be the rounding off and stuff. Just allow me to answer the question, to respond to the message here. All right. Sorry, I'm just typing the reply. Are you getting it, Miss Ngube? Miss Zinga? Who else is with us?
Yes, I.
Oh, so you are the only person with a robust network today.
I think the others are a problem.
All right. Right. So that's how you compute your best case NPV and everything. If I may check with let me see if I can check with the marking scheme here. There should be a marking scheme. Yes, there is this. Let us check. Yeah, I was super fast in typing because I just wanted to show you to be proficient in your Excel skills. But the process of checking is not necessary in an exam. It's not necessary. If we check here, well, our figures 51,733 or on project alpha, I'm sure project alpha is what we need to check on. Right, 51,733 is correct. We have it. Then in year 2, 5232. In year 2, Okay, are these net cash flows or discounted? Oh, sorry. We have to check on the net cash flow line. 5755 in year 2. 5755, correct. In year 3, under net cash flows, 11227. 11227, correct. In year 4, 27301. 27301, correct. It's a rounding off. You can see it. The answers are correct, are the same. In year 5, 32184. What we got here, 32184. Again, it's correct. It's because it was the effect of rounding to 2 decimal places. They were rounding to the nearest whole number. Yeah. So once you have this, it means everything else here is correct. 5.1, correct. It means our purchasing power parity and everything here is again correct. So in an exam, you don't do it like this. You won't finish. You won't finish. To show workings separately, just embed them in your formula. Right? So there are components, tax benefit on capital allowances. So everything else here is correct. So continuing. You know, I rarely check answers. It's a matter of you being a student. Perhaps you need that assurance.
But then I have a question on the issue costs.
Yes.
I remember, if my memory serves me right, you had said that we do not tax issue costs. So what's the difference with this one?
Oh, well, it's an assumption. Oh, it's an assumption. No wonder why I said let us assume.
Okay.
Yeah, because you just write it in the assumption. It is the issue of issue costs. Oh, it is the issue of issue costs. If you check, which has resulted in us getting different figures. It's just the issue of issue costs. Yeah. Best case issue. Notice issue costs. They didn't tax them, but they calculated them fine. But you notice, even if you have done it like this, your final answer or decision will not change. If you say, let us go by this particular project, it will still be the same. Like here, we ended up getting what? 75739. If you subtract the differences between, you find it all boils down to issue costs. This tax benefit on issue costs. Okay. So if you put 0 here on issue cost, tax benefit on issue cost, like put 0, delete this line, you will see our answers will be more or less like what they have there.
Okay.
Right. So let me say undo. Okay. It's an assumption. Everything you do, you state in the assumptions what you assumed. Yes. Oh well. So next, where's my paper? It's disappeared. Oh, it's saved. Oh, okay. You know what? I'm not seeing. But it's like my Excel is on another document and this is on another document. What is happening? Continuing. Project, okay, calculate alpha's duration based on base case NPVs 2 max. So project duration, you remember how it is calculated? So it's I come here and say project alpha's duration. Project alpha's duration. Now, you know, you simply say yeah. Yeah. You say yeah, 1, 2, 3, 4. Notice when you're calculating duration, you don't include year 0. So you say Pvs these cash flows. What are the PVs of these cash flows? You simply say equals, okay. You know, we don't have the PV, so we have to calculate them. We have net cash flows here. So you say net cash flow that we have here. You multiply this by 1,1 to the power minus n. Remember, that's how you, or to the power minus, for you to get present values like this. So these are your PVs. I'm doing it deliberately to show you that you can just work it out like this. Then you say PV times year, PV multiplied by T, which is your year. Yeah, your T here is your year. Is your T. So you're simply saying equals this here, multiplied by this. And then what you do is do that. And here you just say sum. What is the sum here? Because sum, you add all this up, get the answer. Then here you also get the answer. You also get the answer there. So this, if we say this is 2 and this is 1, it means project duration. Project duration equals 2 divided by 1, which is equals 2, equals this over this. You get your answer in years. That is project duration for project alpha. You can verify if this is the answer which was obtained here. Project duration in years, 3,04 years. So here you are. There are various ways this is calculated. So like PV, or notice PV times year, and then that is PV times T. So it's total of PVs into PV times year, which is 173 divided by 57, which is exactly what we've done, 173 divided by 57. So you get the answer, but we are doing it in such a manner that we are saving a lot of time. So in this paper, I am standing at how many marks? I'm standing at 8 plus 8, 16 plus 12, 28 marks. Notice 16 plus 12, 28 marks. Then evaluates and justifies which project should be chosen based on factors which Okan considers important. This evaluation should include assumptions made. So already I'm at 28 plus another 8. I'm already in the 36 mark category. Now, when you're evaluating, remember, this is a report. So you were doing all these in the appendices. So when you come to the report, notice how it is presented. Like this is your marking scheme here. All these were appendices or workings. In the report, you just bring summaries like this. You just bring summary to say best case net present value, adjusted value, project duration. Notice project duration for beta was already given. Now, when they say recommend which project should be chosen, basing your decision on factors which Okan considers important. You need to know that what are these factors which Okan considers important. What are these factors? So you get these factors from the introduction. It's saying here, right? like this. Oh, sorry. Oh, it's super sensitive. And this is what I want to show you. Okay, so notice, let us read the highlighted part. Previously, Okan company used the relevant risk-adjusted discount rates to calculate net present value of projects. However, the finance director believes that calculating adjusted present values of projects would be more appropriate. Okan wants to base its decision on which projects to invest in on returns generated by the project risk as measured by project duration, and important non-financial aspects. So you now know that they want to use using returns generated. They are saying finance director believes calculating adjusted present value is appropriate. So we are now going to base our decision using APV. You are also going to base our decision using what? Project durations. We are also going to base our decision using other non-financial aspects. So when you have summarized now your issues here, you'd say Okan of late has considered APV approach as the best way to appraise projects. So the conventional metric of net present value is not going to be utilized in this particular situation. Based on APV, Project Alpha appears to be more favorable. Project Alpha appears to be preferable than Project Beta. And based on project duration, if you are to go by project duration, you'll notice Project Beta is preferable to Project Alpha because Project Beta is a shorter duration. However, it's because a conflict is reflected in this, still the decision of APV will take precedence over the decision of the project of the project duration. So the firm is advised to proceed with Project Alpha. However, this final decision depends on the assumptions which are discussed below. And then you now come to your assumptions bonanza. You know, assumptions bonanza. What are the assumptions? Annual cash flows, inflation rates. Annual cash flows, inflation rates, and exchange rate forecasts are assumed to be accurate. The validity of this assumption can be investigated by carrying out sensitivity analysis, etc. It is assumed that these projects are to commence only in 6 months' time, and there is no further delay, and they are to last over the duration of the project. There are no options to dispose the projects prior to their completions or to extend the projects after completion. The management must satisfy itself that these assumptions are not available. If they exist, the value of these options must be calculated using real options method and incorporated in our APV estimates. Another assumption is, because we are getting a subsidized loan for the remainder of debt financing, the assumption there is the current government will remain in place over the duration of the project to sustain the subsidy. In other words, to prevent a situation where new government may come up with an early recall or early payment of that particular loan. Another assumption is components are to be imported from UK, and you know, we have calculated the exchange rate using purchasing power parity. So the issue is, Yas Island is outside the UK, so the UK government is unlikely to put export restrictions and stuff on the price of these components, etc. So this is how you come up with assumptions. Assumptions are something that you can easily deduce from the scenario. And already we're 26 mark category. Make sure you write for 8 marks, write at least 4 assumptions. You can see I'm not just stating assumptions, I'm discussing an assumption. And then you can now have a look at You know, the other 4 marks are on the style of the report. So if we were on 36 plus 4 marks, it's now 42. If we are in an exam setup, in an exam situation, I always tell you something. If you are in an exam situation, this question has got 50 marks, so it has to be written in 1 hour, 30 minutes. We started this question around 20 past 6. And now it's 7:42. We are almost done with the question in less than 1 hour, 30 minutes. So it's possible. Remember, we just picked the question at random and we ran with it. And in 1 hour, in less than 1 hour, 30 minutes, our number 1 is done. Our number 1 is done. This is what I wanted you to see for yourself. Now let us wrap up number 1, and then I will send you the video for the remainder of discussions. Because I want you to be, this is how you must proceed when you are revising AFM. Be super fast, time yourself and make sure you just multiply number of marks times 1,8 because it's 1,8 minutes per mark. Now discuss why Okan subsidiary may be exposed to economic risk and how these may be mitigated. Discuss now, it's here economic risk and risk categories. One of Okan's subsidiaries in Yaseland, which produces and sells products domestically, has still found that it is exposed to economic risk. Directors of the subsidiary believe that this is because Yaseland government has maintained relatively high interest rates, even though inflation in Yaseland is now under control. Now, this is like basic economic principles. Why is it if you have high interest rates, you can experience economic risk even though you are producing and selling domestically? You know, if government raises interest rates, it becomes expensive, you know, to obtain money, or the money in circulation is affected. Government, by government raising interest rates, the money in circulation, there is a reduction in money supply in the economy. And when there's a reduction in money supply, there is depressed demand for products. No wonder why, even though the subsidiary produces and sells domestically, it's exposed to economic risk exposure. Yes, high interest rates, it's difficult to obtain money supply, reduction in demand for the firm's products. Also, high interest rates, you know what it does? High interest rates makes it difficult for the firm to obtain loans to expand its investment and stuff. So this subsidiary is also getting those difficulties. If the products being sold are supplied, if the products being sold are sold by credit or are sold on credit and there's high interest rates, it becomes expensive for consumers in that Yaseland to buy products from this subsidiary because the government has increased money supply, making it expensive for products which are offered on credit. So this is what we are supposed to discuss. Why is it if there is high interest rates, even though you don't sell your products internationally, you are still exposed to economic risk exposure? So that's what the question is saying. It's only 4 marks, but you can expand it for as long as you can. Like, if there's a high interest rates, for example, according to interest rate parity, the currency of Yaseland will depreciate against other currencies. You know that high interest rates, the currency of, according to interest rate parity, if a currency has got high interest rate, its value will depreciate against other currencies, making what? Imports cheaper. So imports into Yaseland will become cheaper because the Yaseland dollar is depreciated against what? Other currencies. So if the Yaseland will be flooded with imports, thereby increasing competitive pressures which this local subsidiary is facing. Okay, so for the rest, you can just, I'm sending the marking scheme here. Or someone is saying, please record. Please record. So let me see. So there you are. Right. So for the rest of the questions, you can now see the marking scheme attached. Now, I wanted to send you something for today. Something for today, which is I wanted to send. Let me see. So, Ms. Ngwe, I'm not seeing majority of your colleagues are having issues connecting on online. So, to the extent of what I wanted to cover with this, especially the element of timing, the element of being super fast. This is the only purpose I had to say in as much as your colleagues are having challenges, let us have this. So I'm going to download it and upload it right away for the interest of your colleagues who were not joining. But this is not going to be the only revision lecture for this week. I'm going to send another recorded video. So the two combined plus this, you have enough for this week. Is that okay?
Okay.
Yes. So you are welcome. You can see I'm also having issues with flu. I have a migraine headache. It's being caused by this particular.
Yeah.
Yes. But I managed to just soldier on and wrap it up. So enjoy, Miss Ngwe, just hanging there. I'm not going anywhere. I'm now sending it. I'm still in my study room. I'm sending it just now, but I have a journey that I have to travel. Even after the lecture, the entire night I'll be traveling. Anyway, it's fine.
I was having a problem with the ACCA platform, revision platform, practice platforms.
Yes.
My
Yes.
spreadsheet is blank. I've been using it all along, but since yesterday it's blank. I don't know if you might have any suggestions on what I should do.
Have you changed your in network portal, because for it to upload it needs 2 MB per second.
Yes, the network is fine this side because I've been using it, but all of a sudden it's blank.
Do you mind sharing your screen so that I can see it?
Okay, let me open it. Can you see my screen now?
Yes. Oh, let me stop recording so that